Hey everyone, good afternoon. It's Hector Aguilar once again with Aguilar Realty Group, powered by EXP. Today I'm joined by,
Ben, your agent with Aguilar Realty Group.
hey, thanks Ben for joining me today. Today we're actually going to go over a topic that I think is a topic of hot conversation, right? In
Yes,
the industry, we're hearing that mortgage rates are on the rise. And
yes.
we wanted to discuss with you as a buyer is how that can affect your actual purchasing power, right? And with inflation going up and talks on the news about the funds rate increasing the rates, we know for a fact that rates are going to go up. So let's go ahead and dive into it. Let's go ahead and discuss it. Mortgage rates is the topic of today's conversation and how it's going to affect you as a buyer and your purchasing power.
Let's do it.
So, Ben, we know there's 5 factors that can change the payment of a mortgage. Can you go over those with us, please?
Yeah. So these five factors that can change your payment are outside of the home price. There are other factors that can change your your mortgage payment.
Mm-hmm.
The first one would be your mortgage insurance requirement,
Okay,
known as PMI,
correct.
and also interest rates, which we'll go more in detail later.
Mm-hmm.
Also, your down payment size, there's different ones. There's from 0% all the way to 20%. So definitely can affect your payment. Credit score, tell us a little bit about credit score, Hector.
A credit score is really important to understand, right? A lot of people see on the news that, there's Own It and Rocket Mortgage and all these companies that are advertising on the radio and TV. And typically for those lowest rates, you have to have a FICO score that super exceeds typically 700 points. So your credit score could definitely affect your mortgage payment. Now, there are banks and lenders that will actually, allow you to take out a mortgage if your FICO score is, let's say, under 680, right? Typically 680 and above is a really good score, but you are going to have to pay a little bit higher interest rate if your FICO is 660 or above, 640 or above, or 620 or above. Right now, we're starting to see some lenders kind of pull back a little bit. There were some lenders that were lending at 580 FICO score and above, but now we're starting to see a little bit of resistance because the market's changing a little bit. But certainly, if you have a 600 FICO score and above, you can still get a mortgage.
Awesome. And also debt to income ratio. Can you explain a little about that, Hector?
Yeah, absolutely. When I started my career over 30 years ago, I started as a mortgage banker, so I understand what debt to income ratio is. And for in layman's terms, basically it's the banks when they qualify you for a mortgage, they take your gross income, let's say in this case $10,000 a month, and they allocate 35% of that gross income for your mortgage payment, which is your principal, interest, taxes, and insurance, right? So that's what we call your front end ratio. Your debt to income ratio is going to combine your mortgage payment ratio along with your debts, car payments, student loans, any installment payments you're making, right? Those kind of debts are going to be counted in addition to your mortgage debt. And some lenders are sensitive about your debt to income ratio. They want to see that typically under 40%. But there are some other lenders, some programs, for example, FHA. If I'm not mistaken, there are some lenders that will go as high as 55% on the debt to income ratio. So the lower your debt to income ratio is, the better your interest rate can be as well and could affect your payment. Great
Awesome.
question, Ben.
Great. Thank you.
Kind of talking about mortgage insurance requirements and down payment, Ben, before we go to the next topic is, if you are putting down a down payment of at least 20%, you won't have to pay the mortgage insurance requirement. But there are
Right.
plenty of loans like VA that has a funding fee, which is actually a mortgage insurance protection for VA. There's also mortgage insurance premium with FHA because they're going 3.5% down. They have to insure it, right? But there
Yeah.
are some conventional programs that allow you to go 3%, 5%, or 10% that don't require mortgage insurance. So just a note, depending on your down payment, that can also affect your payment.
Okay.
All right. Moving forward, like I said, I started in the business 30 years ago, and I started as a mortgage banker in my first 8 years. And I know people are concerned about the interest rates being above 3.5% when it comes to the current market conditions. But I wanted to kind of go over what the last 5 decades have shown in terms of the average interest rates that we've experienced, right? So I started my career in the early 1990s, but in the 1970s, the average interest rate that we see here is 8.8%, right? In the 1980s, we saw that interest rates were at 12.7%. So in the 1990s, when I started, the average interest rate during that time period was about 8%. And when I first started my career, I actually started refinancing people or folks out of interest rate or out of loans that were 12, 13, 14, even 16%. So it was super exciting to help these people save hundreds of dollars in their mortgage payment, and they were dropping their interest rates like 4 or 5%. So, and then moving on to 2000s, we see that the average interest rate was about 6.27, and in the early 2010s, the average interest rate was about 4.9%. So right now, we're starting to see that interest rates have creeped up a little bit, but relatively comparing it over the last 5 decades, interest rates are still good.
I agree with you. Yeah, definitely. Especially it says right there, current rate is 3.55%. So we're pretty normalized right now. It seems like that just like popped out of my head that we're in a normalized current rate after a 5 decade period. And when people say, is the market going to crash? That's not going to happen. I mean, numbers tell facts, right? So thanks for
Absolutely. I
sharing
mean,
that.
obviously, we experienced something in the early, 2000s, 2006, 2007, 2008, that was highly driven by the mortgage products that were out at the time, right?
Yeah.
But we see that over time, the interest rate has been somewhere around the 4%, even in 2010s, and something higher. And we've always had a healthy market, right? So in real estate, we think of like, well, is it a buyer's market? Is it a seller's market? And the truth is that there's just a real estate market. There's going to be sellers in any market, and there's going to be buyers in any market. The
I
point of
love
today's
that.
conversation is we want to make sure that people understand that interest rates are going to affect your mortgage payment, right? So Ben,
Correct.
why don't you go over the last 5 years in terms of what the interest rates have done compared to what we're seeing right now?
Fantastic. So the mortgage rates here are an average of 30-year fixed rate. So
Correct.
in 2016, it says 3.65. 2017, 3.99. Slightly higher in 2018, 4.54. Going down 2019, 3.94. 2020, when I started, 3.11, and now a slight increase in this current market today in the 3.55. And just to notate, Freddie Mac is the source of all this information. So really crazy to see how, when you said you were started 30 years ago, how
Mm-hmm.
you're seeing a, you know, increase. It was high, right?
Oh,
For
absolutely.
years. And you're able to see the decrease. And then for me, it's like I'm seeing the increase. But in the next several slides, we'll explain how that affects with the monthly payment, right?
But,
So
it's interesting, Ben. You started in real estate in 2020, and the interest rates were at 3%. And
yeah,
we're going to kind of discover or review exactly what that looks like in terms of what we're looking at right now. I think a lot of people were spoiled at 3%.
yeah,
Last year we experienced rates that were under 3%. And
yeah.
so I think buyers are concerned like, oh man, 3.5%, 3.7%,
Yeah,
it's going to be a lot. But honestly, it really isn't when we compare it to what we've seen over the last 5 years. So
fantastic.
speaking about that exactly is, the point of today's conversation is how is interest rates going up going to affect your mortgage payment, right? So we put
Yes,
together a little table here for you to see, how this affects your purchasing power. These numbers here that you see are 690, 670, 650, 630, and 610 are not your prices, it's your loan amount. Okay. So it's good to notate that just because I want to make sure that people understand that it doesn't matter what the price of the home is. What matters on your mortgage payment is the amount that you borrow, right? Not necessarily the price. Because, for example, if someone bought a house for 750,000, but they wanted to put $100,000 down, well, let's go ahead and look at the middle table here at 650, just to make it easy and simple, right? If someone would have secured a loan, when the interest rate was at 3%, maybe towards the end of last year, we clearly see that their principal and interest payment is $2,740, right? If they
right,
were to take out that same mortgage today, $650,000 on your loan amount, let's just say at 3.55 right now. Let's be conservative. Oops, sorry. Let's be conservative. We're seeing that the payment difference in principal and interest is just under about $180, right? So there alone, you can see your mortgage payment is going to be impacted by $180. Now, there's rumors that interest rates are going to hit the 4 and 4.25. So let's talk about it. Same loan amount. We're looking at $650,000. Let's just say that it does hit 4% by the end of the year. You see clearly that the difference between 3 and 4% is a good almost $400. So $380 more or less. So Again, a lot of buyers are thinking about, well, I want to wait for the market to come down because interest rates are going up. Maybe I don't want to pay a higher interest rate, but let me tell you, the longer you wait, the more money it's going to cost you out of your pocket. And it may not seem like a lot of money, but we've prepared a slide for you that Ben's going to go over that's going to show you exactly how much difference that could be in your pocket if you decide to buy now, even at an interest rate at 3.55 or 3.6% versus even 4%. So I hope that makes sense. If you have
Yes.
additional questions, we're always here to help you out and answer your questions with regards to your purchasing power. And again, remember, we're not licensed mortgage officers. We just look at interest rates every day. We see what our buyers are going through as far as their pre-approvals with their lender and some of our preferred lenders. But our point is to give you the information and educate you so you can make an educated decision as to your buying decision. Okay. So Ben, why don't you go over this slide on how much more will it actually cost?
So yeah, how much more will it cost? Great question. So between this month in the first quarter, if you have a mortgage loan of 600,000 with an interest rate of 3.5, you have payment and interest of 2,694.27. If you wait till next year, and because homes are appreciating, you see that mortgage loan a little higher with a higher interest rate, 3.8, you're going to have a higher payment and interest, which is 2,971.88. The difference is $277.61. You might be thinking no big deal, but if you look at an overall 30-year life of a loan, that's almost $100,000.
Wow, that's a lot of money.
Yeah, it's pretty incredible right there.
I mean,
So
can you imagine? Let's say you're okay with that 277,000 or $277 difference a monthly, right? But instead of making it into your mortgage payment, you put that into like a 401k or maybe your investments or your stocks.
yeah,
I mean, you could certainly make more money. Instead of costing you $100,000, you could make maybe $150,000, maybe $200,000 over the same 30-year period. Who knows? You might even be able to encapsulate $1 million,
yeah,
over 30 years if you put it in the right stock vehicle, right? Or the right
exactly.
investment vehicle. So it may not seem like a lot of money, but $277 a month over 30 years definitely shows us that it's close to $100,000. And I'd rather keep $100,000 and invest it in something else than rather to give it to the mortgage company, right?
I agree. I agree.
So with that in mind, I just wanted to kind of discuss with you a little bit, over the last 2 years from January 2020, where interest rates were. We see that in January 2020, we saw interest rates start at 3.7%. And over the course of the first quarter of 2020, we saw it drop down, and we see that in the early months of the pandemic, there was uncertainty in the market. We didn't really know where the market was going to head, whether it was going to affect real estate market negatively. And honestly, everyone expected that. But the truth is that a complete reverse happened, right? I think because of COVID, people decided that they wanted more space. They wanted maybe a bigger home with some yard space for their kids. And then the other advent too was that more companies went to working from home. So people needed some more space. They didn't need to travel into their office locations in downtown, or they cut their commute down altogether. And I think it definitely was a catalyst to what the market went to. Now we see that in April, we saw a little bit of an uptick. It got down to a 3.3%, and then it got an uptick just under 3.7%. But then over the period of April of 2020 through about January of 2021, we can see a consistent drop in interest rates where it got to about 2.6% at one point for a 30-year fixed mortgage loan, with 20% down. So then after that, first quarter of 2021, we saw a little bit of an increase and a little bit of a dip, but it still remained at about the 2.7%. And then in March, April, and May, or March and April, we see that there was a pretty good uptick. It got to about 3.3%, and then it experienced another downtick. And we benefited, or when I say we, buyers benefited from these downticks. So like in July and August were good months to tie down interest rates at about 2.7, 2.8%. But since then, since August and going into September, we can see a steady increase of the interest rate going up to about 3%, 3.1%. But here's what happened over the first month of this first quarter, right? Coming from January into February, we saw a steep increase, right? And what's affecting the steep increase? There's certain market conditions right now. Inflation is above 7%. So I think the government is trying to control that because things are getting expensive, right? So the
Yeah.
Fed funds rate is going to increase their rates. That's going to affect mortgage interest, and the 10-year Treasury note's going to be affected as well, which affects interest rates directly. So this is where we're at today. It's hard to say. The next question is, where are rates headed to? Where do we see them going, Ben?
So, and we use these people as our evaluation. We use Freddie Mac, we use Fannie Mae, we use the MBA, which is the Mortgage Banker Association, and then also the NAR. And what it shows in the next few quarters, from next second quarter all the way to next year first quarter, a definitely an uptick. All the way up to 3.82%. You want to
Yeah.
explain a little bit more on that?
Yeah, no, for sure. I mean, Freddie Mac and Fannie Mae are government established entities that are in place to purchase mortgage-backed securities in the secondary market. So they're definitely authority when it comes to mortgage rates, and they've been in place for many years. And they're starting to project. You can see Freddie Mac started just at about 3.6%, which is where we're at right now, and they project over the next 3 quarters that it's going to go up to 3.7, maybe even end up at 2023 first quarter at 3.8%. Fannie Mae, they seem to think it's going to be a little less. They've estimated that second quarter 22 is 3.3 and all the way up to first quarter 2023 about 3.4%. The Mortgage Bankers Association, which is an association composed of mortgage bankers across the country, they seem to think that 3.5% second quarter is going to be about the consistent, and they project that through quarter 2023 it might go up to about 4.1%. The NAR, who also has economic advisors that are looking at mortgage-backed securities and where interest rates are heading, they too are projecting increased rates from 3.5% to at least 4%. So if you average it all out, it looks like between the four of them, they're thinking that within the next year, interest rates are going to go up to about 3.8%, 3.82%.
Wow.
So the truth is that, they don't see rates coming down. And if you're a buyer kind of sitting on the fence, waiting for the prices to drop and waiting for interest rates to drop, honestly, I think the numbers show where the interest rates are heading. And the truth is that you're better off buying a home now, competing less with buyers right now because you're in the first quarter of the year and securing a lower interest rate. So anyway, that's a little bit about what we wanted to talk about today. I think now is still a good time to buy. I
Yes.
really don't see, the inventory, the price is going down because inventory is still low. Now we're coming into the early spring months, typically March, April, May, are months where sellers are starting to think about putting their homes on the market because they're looking forward to the summer months where they can sell and then move to either other states or other cities, or maybe move outskirts to the suburban areas. So expect a lot of activity coming this second quarter of 2022. If I had to give you a word of advice, not because my experience has shown me, but because the numbers over history have shown us, the rates are definitely going to continue to go up, and you're better off buying a house today, securing a lower rate that's going to save you money over time. So hopefully what we showed you made sense. Thank you, Ben, for helping me go over these charts today. I really appreciate your input, and I hope that buyers see the value to what we're bringing to every single week. Stay tuned next Wednesday. We will bring you more valuable information. And thanks again for joining us every Wednesday at 1 o'clock for our weekly video contribution to our community. Once again, I'm Hector Aguilar of Aguilar Realty Group.
And Ben, your agent with the Aguilar Realty Group.
We look forward to helping you, and we look forward to being your advisors if you do decide to buy. Reach out to us. You can find us on Instagram. You can find us on YouTube. And you can find us on Facebook. We're all over social media. And you can also find us on our Google business. Just search for Aguilar Realty Group in La Puente. We'd look forward to helping you out. Take care, everyone. We'll see you next week.
Have a good day.